There's a number sitting on the Fed's own website that most people never see. And once you see it, banking stops making sense the old way. Since March 2020, the reserve requirement for every bank in America has been exactly 0%, not 10%, not 5, 0, which means legally a bank doesn't need to keep a single dollar in the vault for every dollar you deposit. And once you understand what that actually means, you'll never look at your bank balance the same way again. Here's the assumption almost everyone walks around with. You deposit $1,000, the bank puts it in a vault. And when it lends money to someone else, it's handing out dollars that already existed. Dollars that used to be yours, just temporarily borrowed. Safe, simple, makes sense. It's also almost completely wrong. Let's build the picture properly, because this is one of those ideas that sounds absurd until you see the mechanics. Think of the barn problem again, except this time you're not a country, you're a bank. Someone walks into your barn and drops off 1,000 bananas for safekeeping. Old school thinking says you now have 1,000 bananas sitting there, and you can lend out some portion of them, keep the rest as a buffer. That's the story everyone tells, but that's not what modern banks actually do. What they actually do is look at that deposit, decide the depositor probably won't ask for all of it back at once, and then create brand new bananas out of nothing to hand to someone else. Not your bananas. New bananas. The original 1,000 never leave your account. A second, freshly created set gets loaned to somebody else entirely. Wait, hold on. New bananas? Where do they come from? Nowhere. That's the point. The bank just writes a new number into a new account. No banana tree required. Okay, but that sounds like the bank is just making stuff up, kind of. That's literally the phrase economists use for it. Banks create money out of thin air every single time they approve a loan. Here's the mechanic in plain terms. Say you deposit $10,000 into a bank. On the bank's balance sheet, that $10,000 shows up as a liability because it's money the bank owes you, and it shows up as an asset too because it's cash sitting in the bank's reserves. So far, completely boring. No new money exists yet, but now someone else walks in and asks for a $9,000 loan. The bank doesn't reach into your $10,000 and physically hand it over. Instead, it creates a brand new deposit account for the borrower and simply types in $9,000. That's it. That's the entire creation event. 2 keystrokes and a number that didn't exist a second ago now exists, sitting in someone's checking account, ready to be spent. Add it up and something strange has happened. You still have your $10,000. The borrower now has $9,000. That's $19,000 of spendable money in an economy that only ever had $10,000 of real cash enter it. $9,000 of it came from nowhere but a bank's decision to say yes. Economists have a phrase for this that sounds backwards the first time you hear it. Loans create deposits, not the other way around. You'd assume deposits come first and loans follow, like water filling a bucket before you can pour any out. But it's actually the reverse. The loan itself is the act of creation. The deposit is the byproduct. Now, here's where it gets bigger, because that $9,000 doesn't just sit still. The borrower spends it paying a contractor, say. The contractor deposits that $9,000 into their own bank. That bank now has $9,000 in new deposits sitting on its books. And guess what it can do with a chunk of that? Loan it out again. Say it lends out $8,000 of it to somebody else. That $8,000 becomes a new deposit somewhere else, which becomes the seed for another loan, which becomes another deposit. Round and round, the same original $10,000 echoing through the banking system, each pass creating a little more spendable money than existed before, until you end up with a system-wide total that can be several times larger than the cash that started it. That's the money multiplier. And even in today's zero reserve requirement world, it still shows up in the real economy, just governed differently than it used to be. So if there's no reserve requirement anymore, what actually stops a bank from creating money forever? This is the part almost nobody explains properly, and it's the actual answer to how the system holds together in 2026. It's not a vault rule anymore. It's capital. Every bank has to hold a cushion of its own money, called capital, equal to a percentage of its risk-weighted assets, generally in the range of 4.5% to 7% for large banks. That capital is the bank's own skin in the game, the money that absorbs losses first if loans go bad before depositors ever feel it. On top of that, banks have to hold enough highly liquid assets to survive a hypothetical 30-day bank run, a rule called the liquidity coverage ratio. And then there's the simplest constraint of all, the one that actually does most of the heavy lifting day to day: interest rates. When the Federal Reserve raises rates, borrowing gets more expensive, fewer people want loans and banks get pickier about who they'll lend to. When rates fall, the opposite happens. That single lever, more than any vault rule, is what the Fed actually uses to speed up or slow down the pace at which new money gets created across the entire economy. And the scale of this is not small. As of early 2026, the M2 money supply in the United States, which captures cash, checking deposits, savings, and short-term time deposits, sits above $22 trillion. The actual physical cash and coins in circulation, the M0 figure, is only around $5.4 trillion. That gap, roughly $17 trillion, is essentially the footprint of the lending and redepositing cycle we just walked through. Money that exists as numbers in accounts, created through loans without a single new banknote being printed for most of it. So here's the uncomfortable part to sit with. When people talk about a bank run, about depositors panicking and rushing to pull their money out, this is exactly why it's dangerous. Not because the bank stole your money, because the bank never had all of it sitting there in the first place. Most of what you see in your balance is a promise, backed by loans that are out in the world, in someone else's mortgage, someone else's business, someone else's car. That's not a flaw hiding in the system. That's the system working exactly as designed. And it's the same design that's let banks fund homes, businesses, and growth for centuries. But it also means the barn problem from the gold conversation isn't just about central banks and geopolitics. It lives inside your own checking account too. It's deposit insurance, capital requirements, and the Fed acting as a lender of last resort all exist for one reason: to make sure the promise your bank made you can actually be kept, even though the money backing it was never really sitting in a vault to begin with. It was always out there working, multiplying, and quietly holding the entire economy together on a foundation of trust rather than cash in a drawer.